Welcome back to the new video, and this video is on chapter 12, where we will cover the option trading strategy using option involving option. And this video is a part of John Seher video series where we explain and summarize the concept in option future and other derivative. So without any delay, let's go to our board and start the chapter, right? Yeah. So trading strategy using option. So everyone know that we one of the most liquid derivative. Liquid means you can understand like the derivative that is traded on exchanges mode. So option is one of the derivative that is traded mode. So there is many combination of option we use to trade, like so in this chapter we will see the option strategy. Let me option strategy by combining option option and underlying asset. We will buy the option and also buy the stocks if it is a stock option first. uh, Different combination of option like call and put of same expiry, different maturity of option, and same option with different s- strike. So these are one of the trading strategy we will cover. There are so many more, so in this chapter this trading strategy is covered, and the chapter starts with 1.12.1. Start with principal protected note. Principal protected note is a financial derivative or product made by bank where your return is based on performance of market, right? But your principal amount, the invested amount, it's not at your risk. The simple case you can think like if you invest 1,000, and if the 100,000, if the market perform well, then it gave you let's say return of 100 and 1,010 rupees. And if the market didn't perform well, but so you will not get a negative return, you will get your at least 1,000 rupees. So your principal is at not risk. The what we say profit we earn is on the market performance, right? So it is a portfolio, right? So it is a portfolio created by a bank. So simple principle, the simple kind of, there is many combination, the simple kind of principal protected note ppn, we can see like a 3 year portfolio A. Portfolio ppn consists of 3 year zero coupon bond with principal 1,000, and the 3 year at the money call option on stock profile, on stock portfolio. So we will explain it So its payoff will depend upon the 1000 the zero coupon bond payoff plus the European core option payoff. Let's say if the market doesn't perform well and the European core option is out of money and its value is 0.10, you will still have the return from zero coupon bond. And if everything perform well, then you have the return from both of them. That's how the basic zero principal note work. And let's see it from retail perspective, retail investor perspective, right? First benefit is there is little risk, and second is you have to think that bank. So bank will try to make profit on your PPN. So you have to think that the cost of making PPN or buying the zero coupon bond for $1,000 or European will be less for bank. So there is a bid ask spread. So bank will buy it for less and sell it for more because bank have to make a profit. And if let's say if we make portfolio like this, let's say we make our own PPN, for us the bid ask spread will be large, and interest rate would be more. So it is not beneficial for us to make the portfolio PPN, right? And now now see let's see from bank perspective. So let's say a retail investor came to a bank and gave thousand said and make a ppn for 1,000 rupees. So for bank the main ppn price or economic structure is driven by interest rate volatility interest rate and volatility, I guess. Yeah, interest and volatility. Let me explain it in simple way. Let's say we gave 1,000 rupee and the zero coupon bond we have to discount it for before. Let's say interest rate is 6%, right? 6 0.06 for 3 year, okay. And that value come around 86.07, right? And we chose volatility equal to uh, let's say volatility is, I guess, 15%, huh? So for 15% we have 86.07 rupees left to buy a core option. So we will use 86.07 rupees to buy a core option. But let's say volatility is increased has been increased, so it is 25% now. So the option price would be around 221. So we don't have enough fund to buy the 221 option of costing 221, right? 221. So that is a financial engineering job for a bank to do. And there is many way to increase our there is many way for a bank to increase the gap or to make a profit, right? They they will cap the profit like a burial option. They will add the option of capping the profit. Or second way, that they can increase the time. If the time is increased, the option will be cheap. The higher the higher the maturity, option will be uh, cheap. So they will increase the time of ppn. Or yeah, and or they will choose dividend. dividend paying stock. So the stock in the PPN would pay dividend, but the dividend would be of bank, not the return investment. So that's the general idea for PPN. And now we will see trading an option with underlying asset. So here we will see the stock option where the underlying is stock, and there are different type of combination. So first, portfolio combination, we will say A, right? 12A would be wrong in stocks, wrong in asset, plus short in call. So let's make a payoff diagram, and it would be like this. We will give the underlying asset. Can I do a straight line? Is there a feature? Green is our underlying asset, wrong stock. And let's give a different color to, let's say, black. No, black, red, let's say black. And now we will give a short. So we shorted the call, so we will get premium first, and then our strike price is K here, so it will go down as it go down, right? And our, let's say, our total payoff would be the addition of this, and that would be like this. Here, and then we have a cap because of our wrong. So this, I can draw it like this. And this color is not good. Let me choose another color. Red color. I think I would paste a photo for it. Let me paste a photo. It would be awesome. Yeah, I have a photo now, and that, the straight line. The straight line is the payoff of our portfolio, and this is used to hedge our risk for increase in price, right? So you can see the short call here and our long stock here. So if the price drastically increase, the short call will protect us from a drastic increase of price. So it is capped, our profit capped, so it is protected. So it is also called as a writing a cover writing a covered call, right? And second strategy is shorting the stock, underlying asset, plus wrong call, buying call, right? And its payoff would be like that. We first wrong call at strike price K. So here is a payoff diagram of wrong call, and then we shorted our stock, so it will go down like this. So our total payoff would be like this. And its diagram is, for a proper diagram, you can see, right? This is also, you can think it is reverse of cover call, right? Or if you think, see carefully, it is like we are at wrong position, wrong call, wrong put. So we have a wrong position put. It is similar like wrong put. And if we see it here, you can see like it is a short put. So we can, what we say, artificially create a wrong put, short put with combination of underlying stock and option. So third is going wrong put plus wrong stock, right? So its payoff diagram will be easy. Wrong put, wrong put. We are at wrong put. This is K, and our wrong put start with here, and then we go here, right? Wrong put and then wrong stock, and then we are at wrong stock. And its payoff would be simple, like this. And then nice. Its payoff is like this, and you can see that it is wrong call, right? And is there anything the investment buying European put and the stock itself? It is also refer at protective put. Protective put, right? Protective put strategy, yeah. So last strategy is short the stock and short the put, and it would be short put, right? We shorted the stock, it will go down. Here is our K, and we also short the put, so we will get premium, and if the prices go down, we will lose the money, right? And so complete payoff structure of portfolio would be yeah. So this will be the portfolio structure, and it is, if you think, it is like short call, right? So it is also called as a reverse of protective put. So to summarize, Alt of 4. Let me put a screenshot. So it is covered called. This is covered called, right? And also you can think it is short put. It is reverse of cover called. Reverse of cover call. And it is, I guess, short. It is, sorry, wrong call. Wrong put, sorry, wrong put. And it is protective put. That is wrong call. And it is reverse of protective put. That is short call. So reverse is short call and reverse of it's short. So remember that. And then we will go to our next chapter, next topic. And this is all because of this is all because of call put parity. There is a relation between both, right? We have a relation with call price with a zero coupon pot or a money saving account equal to put price with underlying asset, right? This is all because of call put parity. Now we will spread, right? We will run about spread. So spread is trading strategy where two or more options are used at the same time. Right? And first is bull spread. So bull spread is a trading strategy where we short the call and we on the wrong call. We also have a wrong position in call. So the short one have a higher maturity K2 and with the strike price K1, right? K1 and this with high match high K, that means it is cheap. And these have a these have a K value result than K2 where K2 is bigger than K1, so it have a high price, so it will be more expensive. So the payoff diagram of bull spread will be like this, right? We have our K1 and K2 here, right? There are different strike price and we are at wrong on K1. So our wrong K1 would be like this, and we are at short at K2, right? And short at K2. So our whole portfolio payoff would be like this. right? Let me show you the picture. It is bull curve square, right? And this is our payoff. So this trading strategy, what we say, give a benefit to a investor from upside and downside risk over also cap the upside profit. So it gives a investor, let's say, a protection from very upside movement in stock, right? So the let's set a payoff with different scenario. So we will see the PF at different scenario at maturity ST, where the maturity of the option is ST. The first scenario is ST. Let me see. Let me give a get a payoff from wrong call option, and payoff from short call and total payoff. And this is the scenario. And let me keep this here. You can't see it, right? Total payoff, right? And scenario number one, when st is resultant k1, the we are at wrong k1 and that is short at k2. The payoff would be st minus k as simple k1, right? Sorry, I mean, if st, the price, um, wait a minute, yeah, if st is less than k1, k1 is here and st, I mean st price is somewhat here, so the payoff would be 0 because it is a core option, right? 0 and 0 and 0, right? And if k1 and st lie below here and k2, so if st lie behind between this, then the payoff would be first option will exercise st minus k1, the second will not exercise, and the total payoff would be st minus k1, right? And if st is greater than k2, I mean st is here, so it will exercise st minus k1, and it second will also exercise minus st minus k1, right? St minus k1, and the total would be st minus k2, sorry, k2, and total would be st minus k1. So this is the different payoff with different scenario, right? It protects us to extreme movement in the market, and that is called as a bull spread, and we can also create it by using option, right? So we can also create it by using put option. That is called as a bull spread. So we created the same structure, let's say, see the same structure using having a wrong position at k1, because k1 will be expensive because it is far away, and k2 would be cheap, right? And we are wrong and k1 and short k2, yeah. So that is, it is called as a bull spread, and the first is called sorry, yeah, right. And second structure is our bear spread, where we short. In this we short put with price k1 and k2 is greater than k1, and plus we also have a wrong position at k2, which strike k2, wrong position at strike k2, right? And its payoff diagram would be like in bear spread. We think market will go down, we think market will go up, and we have to protect ourselves. But in sorry in bull, we think market will go down up and stock price will increase. But in bear spread, we hope or we think market will go down and we have to protect ourselves from going down, market go down. So its payoff diagram would be as simple like this. Sorry, is it straight? Let me do it straight. Yeah, and the payoff would be k, it is k2 and k1, k2 k1, and the different color pen would be, so k2 would be the option. Wrong put would be expensive because k is bigger, and the short call would be not so expensive, it would be cheap. So the total payoff would be like this here and here, right? So let me show you the diagram. This is a diagram where k2 is expensive one, the wrong one is expensive one, and k1 is a cheap one. So we protected ourselves from going up till the loss here, and we capped our profit from market going down till here, right? So that's the salary basic concept. Let's make a payoff diagram where it is a scenario, and if first is payoff of wrong put, and we have a wrong at k2, and sorry, it is payoff of here, right? K2 short put at k1 and total payoff. So scenario 1 where st is greater than k2. If it is greater than k2, the payoff of wrong put would be 0, and wrong short put would also be 0, and the total payoff would be 0. If it is between k1 st and k2, so it is bigger than k2, lesser than k2, so it would be k2 minus st, and the payoff would be here 0, and because it is not less than k1, and the total payoff would be k2 minus st. If st is smaller than k1, here, if st is here, if st is here, the payoff would be, wrong put would be k2 minus st, and short put would be minus k1 minus st, because we shorted it. So the total payoff would be k2 minus k1, right? You can do this maths, it is simple. K2 minus st, st minus k1 minus st plus st, so this will cancel out, so that is k2 minus k1, like that. So it is simple, and that was bear spread, and we can also do it using core option, and bear spread using core option is like that. So in this case we will price the wrong strike k2, right? This is so here the wrong call k2 would be expensive one, and the short call would be cheap one, right? And the payment, it is a replication of bear spread. And another type of spread in this chapter is box spread, right? Box spread. The box spread is a combination of bull and bear spread, where the profit is capped in all scenario. Profit would be k2 minus k1 only on what there is no diagram given in the book, but I found this online. So this is the profit capped, k2 minus k1 in all scenario. So let's find the scenario from all it, right? And it consists of payoff of box spread, right? Let me go down. Where is OBS? Yes, payoff of box spread. So stock range, payoff from bull call spread, and payoff from put spread, and total payoff. So if st is greater than k1, if st is greater than k1, the bull spread would be 0, but put spread would be k2 minus k1, right, from our, and that would be k2 minus k1, right? Final, if k1 is between st and k2, and it would be st minus k1, and this will be the k2 minus st, and the final payoff would be k2 minus k1. And this is done when we don't know what will be happen, and we have to earn money, and this is only possible in European, not American. So only possible in European type of option, or all option have a same maturity, right? It will be k2 minus k1. If st is greater, the payoff would be 0, and that would be k2 minus k1, and that is the box spread. Another type of spread is butterfly spread, and here we have 3 strike price, and it is very popular. Here have we k1, k2 and k3, which is like this. K3 is bigger, and here we buy 1 wrong, we buy wrong k1 and wrong k3. So k3 right? K1 is expensive because it's a core option, and K3 is cheap, right? And now we will short two core option at K2, right? So it is a butterfly spread. So let me draw it for you. So that is our, here is our K1, K1, K2, and K3, right? So we said we will buy a wrong, K3 will be cheap, right? K3 will be cheap, so it will start from here. Wrong call, and it will go like this, and then it is our K3 call, and now wrong call. Now we will wrong call K1, and it would be expensive because it is far away from the state, let's say, and it start from wrong call K1, right? Then we will short two put, short two call, right? We are on at K2, and that will go like this, and the final payoff would be like this. There is a spike, it is also called as a spike option, spike strategy, and this is would be at K2, sorry, K2, and like this. So our downside is risk, and this strategy is best when we know that the price would be at spot price. So K2 is decided, right? K2 is equal to current spot price. So we know that at future some the price of the ST would be near K2, so we have to earn profit. So, and if the price is more diverted, and we will be at a loss, but we would be at capped loss, capped loss, right? The loss would be not so much. And the diagram I should show you because it is easy to understand. Very easy. Right, this is the butterfly spread. This is expensive, so that's why it is down here. K1 is expensive, it is cheap, and the payoff of long call, and then we shorted, we earn money from to earn money, right? And that this is our payoff. And if the price is between this, we will earn money, and it then we will lose it. And the diagram of this would be simple, let's say. So we decided K2, so K2 is S2, SO equal to K2, and K2 is equal to 0.5 or half, or sorry, half of in between both of it, right? K1 plus K2. So the diagram would be stock range, payoff of wrong call, first wrong call K1 wrong call, payoff of K2 wrong call, K3 wrong call, sorry, and fourth would be payoff of short call, and fifth total payoff. So first scenario is if ST is smaller than K1, then the payoff would be 0, here also 0, and payoff of short call would also be 0, and then all is 0, right? Second scenario is when K1 it is between K1 ST and K2. So the scenario is when the spot price is between this. Let me erase it first. Second would be it is between this. So the payoff would be this. That is K2 minus K1, right? We will show it how. ST minus K1. Right? So first payoff would be ST minus K1 of a call option. Second payoff would be 0, and third payoff would be minus 2 of ST minus K of K1, right? And the final sorry, yeah, its payoff would be also 0. Its payoff would be also 0 because strike price is K2, not K1, right? And that would be 0, and the final payoff would be ST minus K1. Right? And if K1, it is between K2, S3 and K3. If it is between here, the payoff would be this, right? And the payoff would be ST minus K1, ST minus K1. Second would be ST minus K3, and third would be, why I'm doing this again, payoff would be 0, and here it would be minus 2 ST minus K1. So after solving some basic algebra, we will get K3 minus ST. You can do it. It is simple, right? So let me do it. ST minus K1 minus 2 ST minus plus 2 K1, right? So it is minus ST and minus K1, and we know that K2, I am doing mistake in rotation. Let me copy paste it and then we will solve it. I have done so many mistakes in this. So let me give you the right payoff of this butterfly payoff, and we would solve it, right? So when it is between here, so it is ST minus K1 plus minus 2, minus 2 ST minus K2, right? And then it will be ST minus K1 minus 2 ST minus 2 K2, and that would be minus ST, and that would be minus K1 and K2, minus 2 K2 minus pen is minus K1, and we know that K2 equal to half of K1 plus K3, that would be minus ST, and minus 2, that would be 1 by 2 K1 K2, right? And it would be cut, and that, and this is K2, right? Minus ST, and that would be minus K1 minus ST minus K1 plus K3 na. plus K3, right? Everything is right, I think. Yeah. And we have K1 from earlier, so these will cancel out, and then it will be K3 minus ST. Yeah, simple. So like that, if it is bigger than K3, then the first payoff would be wrong call, second payoff of second call would be also there, and this is the final payoff, and the final payoff would be 0. You can do it by yourself, it is simple. And yeah, so it's how butterfly work. And if ST is 60, let's say X0 is 60, and we want that the price would be between ST, and we have to earn money, so that then we will create our butterfly spread, and it would be beneficial for us. And another type of spread is calendar spread. So calendar spread, right? It is a spread where same strike price is there of different option but different maturity, right? It can be created by saving option of small maturity or a real maturity, and going wrong on wrong maturity. So it is done like this, and we know that longer the maturity, ex more expensive it is, right? And this is the payoff diagram of the calendar spread. Here this is, we short the small maturity, the earlier maturity, and we are the wrong. If the strike price, if the spot price is near the strike price for a earlier maturity, we will earn profit, right? And let's say if we expire, if the short expire, and but still we are on the wrong call maturity, wrong call, and it is inter money, then we will earn money from inter call money. Yeah, it should be near the K, very near, close to near. Only then we will earn money on a wrong maturity, and that's how it work, calendar pair. And then we will run our combination, right? Combination strategies. And first important, so combination strategies is the trading where we we have position in both call and put, both call and put. And one of the most famous one is trader, where we have position, we have a wrong position on call and wrong position on short. So it is done when we know there will be extreme movement there, extreme moment in market, but don't know at which side, at it will go down or it will go up. So that is a trader, and its payoff diagram would be like this. right? We had wrong K is our price. Okay. We are on wrong, and we are also on wrong put. Put is always, let's say, ah, always expensive than call if there is a strike price, right? So put will go down and it will go up here, and the trading would be like this. Final portfolio strategy would be like this. If it is the market is near K, then we will have huge loss, and if it is there is an extreme movement, we will earn money from both sides. So that's the case. It is way riskier. And one thing I forgot to mention uh, about calendar spread is there are types of calendar spread. Neutral calendar spread. It is when we know the price would not change. There is bullish calendar spread. So this is a calendar spread where we know that the price will increase, so we will make it like this, right? And there is bearish. Bearish will be here, right? And there is a concept called reverse calendar spread that is opposite of this 12.8, opposite of calendar spread. It will go like this, right? And that's all I wanted to cover. And straddle, you understood the straddle. This is called bottom straddle. Bottom straddle, and the payoff would be like this. Let me show you the let me show you the straddle photo. So this is a straddle, bottom straddle photo. Right, the payoff would be like this. Range of stock, payoff of call, payoff of put, and total payoff. So if ST is below K, the payoff would be 0 and the payoff would be K minus ST. And the total payoff would be K minus ST, right? And if K is greater than ST, then the payoff would be ST minus K 0, and that would be ST minus K. So that's how the straddle work, right? And is anything I left to cover? Another topic is strip and strap. So strip is a spread where we have a one wrong position in core, European core, and two short position on put. wait a minute. A strap consists of a wrong position in two European call and one put. Sorry, two European call and one put. Right. And second, strip. Wait, the strip, a wrong position in core, a wrong position in core, and two position in put, right? That is strip. And a strap consists of wrong position in yes, here there is two core wrong position and one put. So let me do it in more proper way. Strip, there is a one core plus two put. In strap, there is two put, there is two core, one put. So the strip is done when investor think there would be there will be highly decrease, the price of the stock would be decreased drastically. So that's why to earn more profit, the strip is used, and the strap is used when the investor think there will be highly price change, the price would move upward, and to earn money the strap is built. So the payoff diagram would be like this. Let me show you. Right, the strip consists of one call, two puts, and you can see that this is more steep, that's why and the strap, this is more steep, so because there is two call here, right? And that's how strip and strap work. Let me go to stranger. Stranger. So stranger, in stranger we have same expiry option, same expiry two option, and but the strike is different. The strike is different. The thing is, we have a core option with strike price K2, where K2 is bigger than K1, and a put price, put option with strike price K1, and its diagram is like this. Right? So let's analyze this. So this is our total payoff of our portfolio, and it is done when we don't know where the price would move, and we know that there would be extreme change in the price, extreme movement in market. So that's why stranger is built, but we don't know. And if the price is between this, then we will face the huge loss. And the in stranger, the price have to move farther than what we say strip point strap, right? And yeah, that's how it works. It is also called as bottom vertical combination. Bottom vertical combination, and it is highly risky, right? The payoff would be if ST is lesser than K1. If ST is here, then the payoff of call would be 0, but put would be K1 minus ST. So final value would be this. And if it is between ST, then 0 from call and 0 from put, and everything is 0. And if it is greater than K2, then ST minus K2, and and the payoff of put would be 0, and that is ST minus K2, right? And that is how and the other type of payoff is made using butterfly and a combination of strips, straps, triangle, and many things. So we can make our own trading strategies using this. And I guess this was the quick summary of it. Was not so quick, but the summary of the lesson, and I hope you understand it. And I will end this video. Thank you for watching. Bye bye.